It's Monday, the 20th of October, 2025, and this is Market Watch, your weekly check-in on everything you need to know about Nigeria's financial market, proudly brought to you by your number one financial literacy platform, Nairametrics. My name is Olusegun, and I'm here with seasoned analyst Idika Aja and financial literacy expert Mukhtar Mohammed from Finance with Mukhtar. How are we doing this week?
Very good, thank you. Good morning.
Okay, and you, Mr. Idika?
Good morning.
Okay, so let's jump right in. We'll be beginning the conversation on the market, NGX ending on a high last week. What's the catch? We saw the Nigerian stock market ended strong with the all-share index rising by 1,989 points, closing at 148,977.64 to be exact. That's a 1.35% gain for the week and a massive 44.74% year to date. And the market cap now sits at 94.57 trillion. That's a lot of optimism packed into 1 week. What do you have to say about that?
Well, let me not use my popular slogan today. Let me try to say it. My popular slogan is that I don't so much bother what the all-share index does, and I like to look at what my portfolio is in. But when you look at the larger market, I think it has been a very impressive week. But you can see that this is largely driven by Dangote, Cement, and also Lafarge that drive the index to the level that. That's why I say sometimes I always want to look at my individual stocks. And if I'm not participating in those two stocks, then you look at MTN. It's largely driven by high cap stocks. Okay. And so optimism is high in the market. Like we said on Monday, last week we said this third quarter is always the earnings season. We're in October. October is always the earnings season for the third quarter results. So a lot of investors are pricing into some of this equity. And after seeing some of the impressive results, the half-year impressive result, and some of the results that have come out, especially from the consumer good, when you look at PZ. So we are expecting Cabre, we are expecting Bois. We're expecting a lot of these companies to come up with their earnings. So I think that's the optimism that is driving into the market. And again, when you look at the other space, you're looking at returns, you're looking at inflation coming down, then you're looking at where can you maximize return. You're also looking at are there other means of investment that you can really key into at the moment. So the stock market seems to be one area that you can beat inflation. And with the low interest rate environment that we are now, a lot of investors are looking towards the stock market. I think that's the optimism.
Absolutely. Thank you for that analysis. And so for you, Mr. Idika, I would like you to break down this strong performance. What sectors or stocks could be potential red flags for investors right now?
Well, thank you, Shegu. Trading in equities actually is a risky venture.
Okay.
Irrespective of the gain, the rally, of course, the return. Normally, you have what you call risk-return variability. The higher the risk, the higher the return. So that equally goes with the equity. I don't think there is any particular sector that can be classified as that risky, so to say. But that said, what I looked at, you look at the normal microeconomic variables that can likely affect some of these sectors. Then you now go to their specific. If you look at, for instance, look at the banking sector. Normally, rates are coming down. Although, yes, normally when rates are up, of course, lending rate will be high, and that will now enable banks at least to make more money. Though that will equally increase their impairments because people might likely default. So the rate cuts, which we are seeing now, is likely to affect them on one side, but on the other side, they can equally gain. Now, the commercial paper, the consumer goods sector, already we know what is happening there because of the rate cuts. Normally, interest rates coming down is likely to affect them too because their interest expense will come down. So I don't really want to see that there's any particular sector that is going to be affected. It cut across, but the most important thing is to look at the specifics.
Yeah, I did expect you to mention the banking and consumer goods sector because of the recapitalization pressure. The fact being, not everyone can meet those requirements easily, and consumer goods, because margin are still tight from inflation and FX cost. What do you have to say about that?
Yeah, so now I'm not of the opinion that most of these banks are not going to meet this.
No, definitely
are going to meet it. It's not so much. One thing a lot of people are not even looking at is they are divided into three stages. You have the international license, you have even the regional license, and you have even the nationwide license.
The national license.
So when you look at all these three, definitely, if you are, I'm looking at the bank, some of them can even begin to look at going international. A bank like Wema Bank already, it seems to be going...
even GT listed on the London exchange.
So those ones are even international before. We are even talking about those that are not international.
That are national, like Stanbic, Wema Bank.
So they have national license, so it won't be a problem. What they are even looking at, some of them are even looking at how they can become an international, they have international license. Yeah. I don't think any of those banks, in short, before we're thinking, there will be a lot of major, we just look at Providus Bank that have not been listed in the exchange and taking over a bank like Unity Bank that's in the exchange. Look at how much they are paying to the shareholders of Unity Bank. And also they've even said they've made the recapitalization. They are not even listed. So I don't think it will be a problem in terms of that. Yes, the risks will be in the area of dilution, which Indika I've written about for a while. That's where the challenge will come. Will this dilution begin to affect earnings going forward? And like I keep saying, it's not about having those capitals, especially when you look at those capitals are just like new capitals. It's not about having those capitals. It's about maximizing returns on those capitals. That's where has been the challenge. And then regulatory framework. How are they able to help them? Because we've been to this stage before where the bank had about 25 billion. Before, they doubled into a lot of areas that they didn't have maybe they didn't have this expertise to run in those places. And you saw what happened. So I think what we will definitely see is that these banks will recapitalize. I don't have a problem with that. Dilution may come in. That may happen. But the main challenge will be with this capital. How much can you generate to your investors? And how much can the regulators be able to make sure that it's streamlined, that in their core area, especially now when a lot of the banking or a lot of these banking companies, banking financial sector are now holding company. So they really need to look at that structure and see that a lot of funds, because again, when you look at those holding structure, the cash cows of those holding structure are the banks. So you must be careful that we are not moving so much from the bank into developing those holding structures that are also very risky. For me, that will be the greatest challenge.
Very well said, Mr. Muktan. Mr. Aja, in what way do you think, for investors trying to enjoy this rally, some safe playing ground for them not to get their fingers burned while at it,
One, generally, first of all, as an investor, you have to define your investment goals, your objectives. That will guide you. Whether you are an income-oriented investor, whether you are value, whether you are for growth. That said, the best thing you can do is you have to diversify your investments. Especially, you pick stock from a particular sector, you pick another one from a particular sector. Have in mind what portfolio am I creating, what is the target, what is my target return on my portfolio. Am I looking at 30% or 50% at the case maybe? That will now tell you the type of stock to actually pick and build your portfolio. So the first thing there is you have to diversify your portfolio. Go to this sector, don't concentrate on one sector because there are specific risk apart from the general risk that you will have that affects all sectors.
Okay, absolutely. And Mr.
Sometimes when you talk about diversification, a lot of people have challenge with diversification. You are saying it in general terms. Some people think, I'm diversifying if I'm investing in different banks. So part of that.
No, that's not this. Yes,
some people will see it like that. I'm not just in.
I'm mixing your portfolio.
You have to mix your portfolio. Either you move we have sectors, you have banking sectors, you have consumer goods, you have industrial, you have
real
health,
estate,
you have health, you have real estate. So you have to look at those
different sectors.
Then and unbalance it. If you go to industrial, you can decide to pick Dangote Cement
No, I wanted you to explain because when you talk about diversification,
most people will just think different firms within the same sector.
They could be in the same sector. Some people think that that's the way I want to diversify. Let me give you an example. The banking sector, I can say I'm diversifying. I'm in tier 1, I'm in tier 2, I'm in tier 3. It's still diversification.
But they fed the same specific risk. You understand?
Absolutely.
If you are going for the banking,
I get it, but I think it's good that we've expatiated on that.
Okay, so Mr. Idika, you expert analyst, there's something you call landmines. Can you speak a bit to that? You know, those indicators you would say investors should be watching closely to catch them off guard. What are landmines?
I think I did a story on that, how to pick the best stock in 2025. You can check Nairametrics, I think it's there. But the key thing there is that what you have to check is liquidity.
Okay.
Very, very important. It doesn't make sense that you can't come in and you can't go out. So irrespective of your investment objective, the first thing you have to consider is the trading liquidity of a particular stock you want to go into. It's very, very important because most of them are tightly held, and any particular, maybe any trades, long trade can influence the price. That might not even be the true position. So it's always good to find out trading liquidity. And in that case, the banking sector is apt. Absolutely, they have the trading liquidity because you can easily go in, you can trade. Normally, I believe that any stock that is trading less than 5 million in a month conservatively for 3 months, for me, should not be considered. I shouldn't take a position there. But any stock that is trading above that, it's okay for me. So first thing, liquidity. Then the second one, like you, for me, then because of time, for me, look at the valuation.
Okay.
Look at the valuation. Even you, Shegu, if you're undervalued, I will buy you. But if you're overvalued, I will sell you. So always find out whether a stock is undervalued or overvalued. And there are traditional metrics you can use to decide that. And if you cannot do that, my friend Mukhtar is there. He's an analyst. He can advise you and tell you, okay, this particular stock is overvalued. The market price is more than the intrinsic value or less than the intrinsic value. At least let's stop at those two factors.
Yeah.
Check liquidity. Check if it is overvalued or undervalued. Then if you want to go for that, look at whether, if you're interested, if you're an income-oriented investor, are they paying, is the stock paying dividend?
Okay.
You understand? And for me, it's very, very important because if you add the dividend and the capital gain, that will not give you the total shareholders return, which is the essence of investing in stock in the first place.
Absolutely. Mr. Mukhtar, speak to volume and profit consistency, please, as key parameters. What do you have to say about those?
Volume, yes, and I think he has driven it already. Liquidity is what drives volume.
Yeah.
If you don't have liquidity, then there will not be volume. There are some stocks that have gained up some percentage of money. I don't want to mention stocks, but you see that they've gained over 1,000%.
Yeah, sure.
So, but again, in terms when you want to trade, you just realize that you cannot trade. You cannot trade on it because there's no volume. So I think volume is key. Like you have said, liquidity is key. In terms of valuation, sometimes I say it's based on, like you have pointed out again, it's based on your goal, it's based on what you want to
do.
Profit consistency. Yes.
A company can be making profit. Yeah, the stock is not. Maybe it has a premium valuation. That means it's not cheap. That the company is making profit doesn't mean that the stock is cheap.
Okay. And again, when you talk about profit, again, the company making profit after tax, profit before tax does not excite me. For me, I tell Indika, it doesn't excite me. It excites me when it now goes to the bottom line that affect the earning per share if I'm an income investor.
Yeah.
So that's the earning per share that will determine what will come to me. Mm-hmm. How much percentage are they going to pay to me? Today, people are excited about Zenith Bank because I think they improve their the payments percentage higher than what they used to pay. So investors are anticipating that towards the year we could get even a better payment percentage. So and that is, you largely know that through the earning per share. If you are an income investor, like you say. But sometimes again, if you are a capital appreciation investor, also a profit after tax, profit before tax will excite you because that will create a lot of hype around that stock, and a lot of people want to come in to look at that. And then you could also make capital appreciation. Like I said, it's all depends on your investment goal.
Absolutely brilliant. Absolutely brilliant. That's not something we get to hear every day. I mean, Mr. Mukhtar here gave us a whole different meaning of diversification, and in regard portfolio. So shall we segue now into the Okomu Oil's massive 9-month profit surge, a 9-month streak? Okomu Oil is one of the stars of 2025 so far, and now the company just reported a 50% jump of profit to 60.3 billion naira for the first 9 months of the year. At the moment, we have earnings per share up by 113%, and they have now been declared 2 interim dividends, 30 naira earlier in the year, and now 10 naira now.
You see what I just said?
Yes.
So those are the kind of stuff that will excite me.
Yeah.
Indica might be excited with profit after tax and others. Me, I'm excited when I hear. You see that word? You say the earning per share has gone up. So it's a good result for me. I don't think people say it's a massive result, but I don't see it as a massive result. If you look at the dividend yield, it's just about 7%, and you look at
up to 7%.
You look at the price and everything. So I'm not too when they say massive. If you look at the second quarter. The second quarter, by the third quarter, the second quarter was better. The profit was about 50%. And this one seems the third quarter. But again, we've seen, if you watch the trend of Okomu, it has always been like that. The third quarter is always a quarter that you don't seem to get a fantastic result. But when you compare this third quarter with the third quarter of the previous season, 2024, you realize that the result is fantastic by 50%. Third quarter of 2024 by first quarter of 2025. But when you compare it with last quarter, half-year result, you see that the result is not as massive as people say. But again, when you talk in Nigerian investor, if you have paid 30 naira half-year interim dividend, and you are not paying another 1 naira, that's a surprise. So another 10 naira, that means you are paying about 40 naira. That for Nigerian investors, dividend always drive the market. So
absolutely,
I think we see some positivity around that.
I think this is even a real incentive for long-term, holders. But Mr. Idika, could you speak to how investors should balance this dividend payouts with capital appreciation in that regard?
One, let's look at it like you mentioned. First of all, let's look at it from this angle. When you say a company has done very well, one, you look at the long-term performance. I think over the 5 years, they have been able to grow profit at a compound annual rate of about 90%. The same thing with earnings, close to 100%. Now, if you look at what they are doing now, even compared to last year, I think they are both profits and earning per share. It's a record 5-year. It's a 5-year record. That means they have surpassed their 5-year, even full year 5-year record. So it is okay because they have been so consistent, and right now we're expecting that by the end of 2025 they are likely to even beat that 2024 result. So that is okay on that level. Now, when you talk of dividends, equally look at the dividend growth. For the past 5 years, they have maintained dividend payments, but dividend has grown at a lesser rate compared to earning per share and profit. So that is where investors, shareholders are expecting them. Fine, you are making money. Why not increase your dividend payouts? Fine, they have tried and they have shown that based on what is happening this year. At least the first interim dividend, they paid 30 naira, I think, compared to 8 naira they paid last year for the same period last year. Now, the second interim dividend, which they have paid 10 naira compared to 2 naira, you can see the growth. So that means they have paid they have paid 14 naira interim dividend.
Yes.
And last year, final dividend, they paid 26 naira. 8 to 26. You can see what they pay. Even what they have paid, the 2 interim dividends have even surpassed the one they paid for the whole of 2025. So we are expecting them to pay more based on this result so that they can compensate investors. Fine. The share price has been fantastic. It has been bullish at 130% year to date. So that is equally good. So I always talk, when you want to get the total shareholders return, you get the capital gain, then you get the dividends. But the problem they have that dividend angle because of the high value of the share price. So definitely the dividend yields is relatively low. So and shareholders are expecting that by the time they increase their total final dividends, I think projecting around 44 naira as final dividend against 26 naira they paid last year. That will take the maybe dividend yields to about 7 to 8%, which is good. So, and they have done very well. And I think it is time to reward shareholders who have been following them. So when you do very well, you give back to your shareholders. I commend them. The result is very, very impressive and it's good.
Absolutely agree. Looks like Okomu is rewarding both camps, those that love to earn and those that like to grow. So, and that's what we call balance. So shall we segue into something much more, for the everyday Nigerian, where to invest 5 million naira if we don't like risk? I mean, they say that to make money, there has to be a little bit of risk, but once you do not have risk at all. Now, let's move from the stock market. Suppose I have 5 million naira and I do not want to take much risk. Where do I invest? Talking about Euro bonds, commercial papers, and the likes, government securities. Mr. Mukhtar.
I'm happy that you said 5 billion because
is it 5 million or 5 million?
5 million.
Is it how much you said?
5 million.
Yes, because that's the minimum entry point for commercial papers, so that's why I'm saying I'm happy that you said 5 million, so that people that will listen to the program also will know that so that they won't start calling you and telling that I have 1 million. Why can I put it in a risk-free area? Once you're talking about commercial paper, there's a minimum entry.
Yes.
But there are other, like there is bond. It depends again. They also have a minimum entry, but also depend on how you want to play it. But I think what Nigerians have it means that they've done is that some of them, they will come together. They don't like risks. They come together and get that 5 million and enter. Then when those returns come, they will not share it between themselves. I think commercial paper is one of the new, we like call the new entry in town, but it has been there. But I think people are well aware of it these days. And Indika said something about commercial paper in our last program, where he talked about looking at the type of companies that you have in this commercial paper suite. Because again, you know, when things start happening like this, you see a lot of companies now come in, and then you now begin to see sometimes failed payment on the due date. But I'm happy one thing, before now, I think commercial paper is more or less like where you have private placement, where it's between you and the company. But I think SEC has come in now to regulate that space in commercial paper. So definitely that brings a little bit of much more credibility into it. And I think it's good if you're a risk-free investor. Look at commercial paper, you look at bond, you look at treasury bill, you look at mutual fund also. A lot of people don't talk about mutual fund, but there are a lot of mutual funds that even sometimes they calculate your earnings. Maybe let me say they're going to give you 10%. And they now do it in such a way that every month they pay you that, let me say your 10%, you put 1 million, okay. Your 10% is going to be like 100,000. They will divide it by 12. So, I mean, every month they will pay you out of that your 10. There are some mutual funds that are run like that. So I think, and those are risk-free. They are fixed return. That's why sometimes you call them the fixed income. Mm-hmm. So I think it's good. For the bond, a lot of bonds are played by larger institutional investors because you need a lot of funds to really get value from in the bond market.
So, Mr. Idika, sorry for putting you on the spot, but now we have to choose one between these three big boys, talking about T-bills, FGN bonds, and commercial papers. Which would you say has the best balance of no risk and, returns right now between the three of them?
First of all, let's grade them.
Okay.
When you're talking of, you have risk-free, that's what we call risk-free assets. You have low risk, you have high risk. Now, when you talk of risk-free asset, you are talking of federal government instruments like Treasury bills, bonds, savings bonds, and ordinary bonds. Why it is risk-free? Because no matter what happens, federal government must pay back. So it is a risk-free assets. And that is the benchmark that you should use whenever you want to invest. So any return that is not, any asset that is giving you a return that is not more than that return from these federal government institutions, that means you are not doing very well. You are likely to lose your money. So first of all, government instruments are risk-free assets. Treasury bill, savings bonds, And I think I will show you the returns so that you understand. But first of all, these ones are risk-free. Whatever happens, you get your money. So it's very as if you're putting your money there and going back and start sleeping. So commercial papers are risk assets because they are issued by corporate entities, corporates. So, for instance, if you are Shegun Nigeria Limited issues a commercial paper,
will you buy it?
Well, I will look at if he has a good rating, I will buy. But if he does not have a good rating, at least I will not buy. So it carries what we call default risk. So it's a risk asset. The same thing with mutual fund he mentioned. Mutual fund is only that they are managed by professionals. So if you can just put your money and most of them they follow a benchmark. If it is money market mutual fund, which they invest in this commercial paper and treasury bills, then you can put it there like asset as some big asset money market mutual fund. But let's look at it this way. Now the last top rate for treasury bill, we are looking at 15.5%.
Yes.
So you have 15 million naira. Let's use that time frame of 1 year. Give and take, you are likely to get about 775,000 naira if you invest 5 million naira. If it is federal government bonds, we're looking at maybe about 14% yield. You are likely to get about 700,000 naira. Now, if it is commercial paper where you have a higher yield, let's say 17%, you are likely to get about 800,000 naira. That means they will return to you you get a return about 5.8. Now, the angle which you maybe you didn't mention is some people use it to diversify, especially for FX stability, that is Euro bond, and even US bond. Some people think, okay, Nigerian assets are not doing very well. No, it's not true. Because if you invest in US 1 year treasury bill, which is, I think about 3.6%. Yeah, because of the exchange rate, you are likely to get, these ones will outperform them. Because if you get at 3.6, you convert 5 million naira to dollar, that should give you about 3,000 or thereabout. Then you now invest. By the time you calculate and convert back to Nigeria, you not make up to 100,000 naira profit.
Okay.
From that, you have 5 million. Meanwhile, the treasury bill is giving you 775. Bond is giving you 700. Commercial paper is giving you 800. So, but the difference is that the commercial paper is a risk-free asset. So you might lose it. So the one that is certain there that you are not likely to lose is the treasury bill, which is, you can see the premium between 775 and 800. Which is about 25,000 naira. So I would prefer I may decide not to take that risk because of 25,000 naira and put my money in treasury.
If I hear you correctly, you are saying you would opt for FGM bonds because of long-term safety, commercial papers because of higher yields, and T-bills because of short-term liquidity. So, Mr. Mukhtar, how would you best split them? Talking about 2 million, 2 million, 1 million between these three.
Well, I've not gotten to that point where I'm a low risk taker, so I like taking risks. But again, if I have to take risks, I would definitely be doing commercial paper first. If you want to tell me what I want to do, commercial papers first.
How will you split the 5 million?
If I have 5 million, I'll put 3 million in commercial paper.
because he can take risk. He said he can take risk.
Okay.
So if he can,
he has a risk appetite.
Because commercial paper from the asset classes we have listed. You have listed now offers
more return.
Offers more return than all of them.
So I put commercial paper, then I put FGN bonds 1 million, then I put 1 million in.
What about you, Mr. Edika? How will you split the 5 million across board?
For me, I will stabilize my portfolio. I will put like 3 million in treasury bill.
Okay.
The difference between treasury bill and commercial paper from my analysis is about 25%.
Okay.
Then maybe I will take maybe about 2 million to commercial paper, then put 1 million. In fact, I don't think I'll even put any in federal government because treasury bills, you know the reason why I will not do that. Treasury bill and commercial papers, they are upfront payments. You get your interest upfront.
Well, for me, I always tell people why are foreign investors coming to Nigeria? Even when we do the Eurobond, they want to come and invest, So why are we? If you are looking for somewhere that you want to live, you have FX. I tell people if you have FX and you're looking to maximize your return on FX, then you can do your Eurobond. For me, that's where. But again, like I always tell people, the time you have value for your FX, sometimes is when you just change that FX back to Naira, then it looks very huge. But when you look at inflation by and by the FX, where it is, even the global inflation in the US, and then look at what they give you in terms of FX return, definitely Eurobond seems to be nice because, again, Nigerian Eurobond is giving about 7%, which is higher than what you get in the US. So in terms of FX, especially when you have FX, you don't think you have need for it. It's not really just staying there in the bank. I think you can also use it to generate some return. So I probably would do Eurobond if I have FX.
Mr. Aja, Eurobond, what's your opinion on them?
Comparatively,
Yes.
I will not do. I have other asset classes that can give me better return.
Okay. You don't think the FX is worth the risk?
For now.
Okay.
It's not.
Mr. Nja, it doesn't need FX. I said, if I have FX.
Yeah.
Do you get what I said? It's rather than leaving my FX.
Yeah.
Just
The
there.
underlying factor is, for me, is the return, and which I analyze. Because at the end of, if you buy now, it's dollar denominated, and when you buy, fine, it will give you, like he said, right now it's about 6.35 percent yields, and if, like we said, if it is 5 million and you invest. You convert that 5 million naira to dollars, and when you earn, you convert it back to naira. If you convert it back to naira, it will not be as much as what you get from bonds, even from total yield from bonds, and even from treasury bill. And remember that treasury bills and commercial papers are paid upfront, so you avoid that reinvestment risk. So you can take your upfront interest and invest and equally increase your overall yield. So why would I do that? Some people don't understand because it is forex and exchange. You just want to, like my friend Mukta is saying. So
we live in a dollarized economy.
What is not giving you what is it? The bottom line is what is the return? That's the key thing.
I totally agree with you. But again, like I said, now we live in a dollarized
Some
economy.
people use it like he said. Some people use it to hedge. But there's no need for me to hedge. I will not.
Hedge, for me, I will only use it to hedge. Okay. But I still believe that I should invest more in the Nigerian market because of more returns in Nigerian asset class.
Okay, absolutely. Thank you so much for your time and your expertise. That was very well said. And to our dear viewers, get to know that whether it is stocks, bonds, mutual funds, or Euro bonds that you want to invest it, it's not about making quick money, it's about making smart money. Till our next episode on Market Weekly, proudly brought to you by Nairametrics.